Good morning, good evening, good afternoon, wherever you are in the world. Welcome to another episode of Email Exchanges. It's been a hot minute, but I'm very excited to be back and I'm looking forward to answering your questions today. If it's your first time joining us in this show, what we do is we open up our email, which is ee@tradedelicious.com, or you can enter email exchanges@tradedelicious.com. You can send in any questions you have that you want to ask us, whether it's about trading, trading, your trading, or simply just want to have a chat to someone about areas you can look for improve. We go through that, we answer the ones we deem too personal and the ones that are kind of generic or we think that a lot of people may like to hear. We bring onto this show and we talk about them live on stream. So today I've got a couple of the questions from the beautiful people in the TradeDelicious community and I can't wait to get through them. So I reckon we just jump straight into it and have a look over at Madison's question to start off the day. Madison sent in an email a couple of weeks ago. I apologize for the delay in the response there, Madison. We did email you privately, but for the bulk answer, I wanted to wait until we got another episode of Email Exchanges out. She's asked, how do you identify and manage risk in your day trading activities? And what steps do you take to minimize losses? It's a very good question, okay? It's a very generic question, which is why I've kept it in here, because I think it can answer potentially many people's question in that. When you're having a look at identifying, so there's two parts to this question. You've got identifying and managing risk, and then you've also got minimizing losses, okay? They're two different things. While they're in the same area, they are two different things and they do correlate a little bit differently. So first, I want to dive into identifying and managing risks. Now, if you ever search for education on identifying and managing risk, you're likely to get pushed down the whole investment route, where you're going to hear a whole lot about diversification. When you're day trading, it's a little bit different depending on how you day trade there. So when you come into day trading, scalping, or intraday trading, diversification isn't necessarily a good thing. We like to focus on certain assets so we're able to really comprehend what's going on in that day, understand the volatility, and be able to manipulate the prices to go in our favor. And you see that with a lot of people. A lot of people like to trade certain sectors, small cap stocks, medium cap stocks, FX, but only the majors, maybe only the minors, the exotics. We could be in indices, could be in commodities, but only gold and silver. We really kind of hone into certain assets to look to trade. So diversification isn't going to come to fruition when it comes to really identifying and managing risk. I think this all comes down to market psychology and market philosophy, getting an understanding on the asset you're trading itself. So identifying risk comes into understanding how volatile are we right now in this current market situation, depending on the asset we're trading. For example, if I'm looking at trading the Aussie dollar, the US dollar, over the past few days, what type of movements have we really been printing? What's been making headlines? Do we have economic data? How are the overall investors feeling about these assets? Now, getting an understanding of this allows me to take an incentive bias, not only in choosing a direction to trade, but also into how much to risk based on that. If I can see that we're having massive sell-offs in the Aussie dollar over the past 3 days, we've got CPI data coming, we've got GDP data coming, you name it, it's not looking too great. Sure, I might be able to find an entry point to buy in the Aussie dollar, but I might not want to risk as much as what a standard position is, because I understand that investor sentiment right now is actually looking to fade this or looking to short that currency. So identifying and managing risk is really about being in tune with the market. It's really getting an understanding of what's going on, where is it happening, why is it happening, and where should you be positioned, how aggressive, how passive, all that type of thing. So when it comes down to actually identifying and managing, position size is obviously going to be the one that determines how much you're risking. How you get in and how you get out is something we'll chat about when we talk about minimizing losses in just a second. But it's all down to understanding the assets you're trading, understanding the volatility that day, that morning, yesterday, or what's expected, understanding those economic events, what's coming, what's forthcoming. Are we expecting a big press conference? Are we expecting CPI to miss expectations and this thing go absolutely mental? All these things need to be thoroughly thought through so you can actually identify different risk events and manage that. In terms of minimizing losses, cutting losses is something I discussed in a recent live trading room. We sat down with a few individuals and we really dove into how and why I cut losses. It's a little bit hard of a skill to predict. Now, when I do enter a position and set a stop loss, I try my best to be out of the position prior to price hitting that stop loss. I consider it a failure if my price does actually go and hit that stop. So that's something just I do because I like to micromanage my scalping positions. I think it's very important to micromanage my scalping positions. When it comes down to minimizing losses, it goes into that effect of building as much data you have to put probability in your favor for X amount of trades, and then trade those trades the way they should be traded. Losses are going to happen. Okay, we're never not going to have losses. We're in a risk-on game. Minimizing them is something we can do through a million different ways of attempting to bring that down, from reducing size to messing with different stop loss formations to cutting losses, scaling in, scaling out. There's a million different ways to do it, but as a whole, what I like to do is scale out of that position prior to hitting a stop loss. Madison, thank you very much for your question. It was a fantastic way to start today's episode. Let's flick on through Jordan. Great name, Jordan. Spelt differently, but great name. He's come through and said, I feel like I'm stuck in a rut over the past few months. I keep making adjustments to my strategy to progress, but it isn't working. Okay. Being stuck in a rut is something that happens a lot. It's something I've felt a million times. It's something most traders have felt a million times, and it's tough. It's really the time where it tests you as a trader. You really need to knuckle down, review your systems, review what you're doing, how you're doing it, are you doing it to the best of your ability, and really dive in. That's where different mentors, communities, and etc. can really help. Just touching on, you keep making adjustments to your strategy to progress. That might actually be what's keeping you in the rut. By the sounds of things, now I don't have much information from you, Jordan, so please take this as a generalization and not as direct advice. By the sounds of things, you're changing your strategy up a lot based on your recent returns. Which is leading me to believe you're doing 10, maybe 20 positions. And if it's not working out in those 20 positions, you're altering your strategy and then doing it again. This is breathing in that vicious strategy jumping cycle, which beginners get caught in, where you're just constantly jumping between strategy to strategy to strategy until something works. It never ends up that way. Whether you're winning, whether you're losing, I highly recommend stick to your strategy. Don't change it, okay? If you've back tested it and it's working, stick to that, or go back to what was working prior to your rut. Go back to the basics and just trade it non-stop for 3 months, okay? 3 to 4 months non-stop. Journaling, have your trading plan, journal how you're feeling about it, journal what's happening, the charts, the images, everything. And over that 3 months, whether you win or lose, if you have to do it on a demo, do it on a demo. I highly recommend doing it on a real account though. Come back after that 3 to 4 months with all of that data, and you'll actually have statistics to prove what adjustments you should make, and whether or not you actually need adjustments in your strategy, or whether it's you yourself that needs to change something in your process, whether it's the assets you're trading are changing over time. Having that data is really, really important in actually making those adjustments. So be sure you have that data before you change anything along those lines. But Jordan, fantastic question. I look forward to hearing what you have for me. I hope you get back in touch in a couple months with that data, and maybe we can go through it together on stream. Let's flick on through Ava. Can you share your thoughts on the impact of technology on the investing and trading landscape and how it's changed over time? This is a good one. This is a good one because there's a misconception out there. Now, I am definitely not the person to sit here and chat about coding, to chat about tech, AI, anything like that. Okay, I'm not, but I am curious. And I'm very curious about these things because I do believe we're moving to that kind of AI or automated intelligence area in every aspect of life. Okay, but there's a big thing out there right now of people thinking EAs and trading robots are AI, and they're not. They're not, okay? EA is that's an expert advisor under MetaTrader, okay, or a trading robot, so to speak, is an automation. It's a form of automation, okay? I will give it the inputs. When it reads those inputs from the chart, it will execute what I've told it to do. Okay, that's an automated process. AI is, it learns. AI learns, reacts, and formulates its own decisions and then acts on those. Now, it's very important you understand the difference. You'll see a lot of YouTube videos out there saying my AI trading robot, blah, 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 did this, did that. My AI, blah, 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 did this, did that. You need to really decipher whether it is actually AI or whether it's just automation. Now, automation, I think, has a long way to go. It's come a long way. But the only times I've seen automation in trading really be successful is when it's still being managed by a human. What I mean by that is they've either got one robot and it changes depending on what the human inputs it, or depending on what the volatility is, they'll change the figures, they'll change the assets, whatever it might be, the humans making those decisions. Or they've got a compiled group of a load of different trading robots, and that's a portfolio. And the traders behind the desk are managing which robots are in the portfolio, are out the portfolio, depending on their performance at different times. So automation has been around for a very long time in trading, and it will continue to be. What's really interesting is with the revolution with ChatGPT and Google bringing out their new one, and everyone really jumping on that AI train, is how long is it before we have AI trading systems, like trading systems where we just give them the data and the AI will come back with the best trading strategy or the best what's worked previously, and then we can trade with that. Now, that's something that really interests me, gets me really curious, and something I may explore in the future through TradeDelicious. But yeah, that's the impact of technology. Like, I think it's great. I think we should welcome this with open arms. It can be scary, it can be different, and it can be scary because it's different. But I think we should welcome it with open arms, and I like the way it's going to go. How it's changed over time, I don't think it has. I think more people are aware of it, and there's definitely more automated trading going on in the markets. You can sometimes see, especially around fundamental releases, you can definitely see where the robots are buying and where the robots are selling. But I don't think it's changed as such. I think it's just become more popular. What's really going to be interesting, as I mentioned, is when the AI technology is really adapted into trading markets. And that's something I would love to explore further. Thank you for your fantastic email, Ava. That's a good little discussion. It's piqued my interest in all of that trading. I hope some of you guys are interested in that as well. Victor, can you discuss the role of market psychology in day trading and how it can affect decision making and trading outcomes? Sure. Market psychology comes down essentially, okay, to where the crowd is investing. Okay, so where the crowd's buying, where the crowd's selling. Now, in theory, where the crowd is doing it, it's going to generate more demand or more supply. Therefore, you should be correct, or you have probability in your favor to be correct when that's happening. Now, that's very similar to the way I trade using the volume. The volume profile is I have a look at where traders have already been interested in these prices, and I go back into those prices. It's very simple. And it does fall under market psychology. When you have a look at simple supply and demand trading, that all falls under market psychology. Now, in day trading, I find it to be less prominent in FX industries, in FX pairs, especially anything kind of CFD based. Now, the reason I say that is majority of the people are trading CFDs, right? Which means it's not printed on real market. So you could enter a $20 to $30 million position. It won't be printed on real market if you're trading CFDs, depending on your broker's model, that is, of course, but there's a good chance it won't be. So I find market psychology to be much more prominent in equities markets, individual equities, because there's less shares, there's less volatility, there's less volume. It's a lot easier to manipulate the price of a share. You know, if you've got a couple hundred or a couple thousand people buying the stock at the same time at the same level, you're going to see that stock price go up quite aggressively. Whereas if you do that in FX, it's likely not going to move it at all. I mean, we do over $500 trillion a day in volume. You're going to need a lot of money to really move that market. So I see it definitely more prominent in equities markets. I might be wrong in that assumption. It's just something I see regularly, and it's something we'll discuss further in another episode as well. But when it comes down to day trading, I definitely use it because I look at orders. I look at order flow and I get an idea of where people have been buying, where people have been selling, and I look to trade around those areas. I look at how interested people are. I look at how uninterested people are. And my whole strategy is built on that, which is market psychology. So I think it's very powerful and it's very important to understand. But I don't think it's the do all and end all when it comes down to profitability for that matter. Jacob, what are your thoughts on using indicators like moving averages to base your trading strategy on? Basing it? No, I don't like it. Incorporating it? Sure. Incorporating it? Sure. I think your strategy should be based on market psychology, right? We've just gone through that. Or some aspect of market psychology or fundamental bias, right? If you're trading earnings or you're trading interest rates, whatever it might be, right? It should be based on something else. The moving average can help you find different areas of interest, but they're a lagging indicator. Okay, so they're just telling you what's already happened. Now, the only time that these moving averages work are when there's lots of other people trading that moving average, right? And that's why they've become so popular, because they are popular. They work a little bit better. Once again, goes back, you'll probably find it works a little bit better in equities, where you don't need as many people buying or selling. When it comes to FX, when it comes to even indices, some commodities, it may be a little bit more difficult. I don't think you should base your trading strategy on a lagging indicator like that, but I do believe they can provide you with extra probability. Yeah, it's an interesting one. It's all down to that. Like if you're just trying to trade a moving average cross or something, it's just going to tell you what price is already done. Especially moving averages cross, they kind of frustrate me because they're so delayed. They're telling you what price is already doing. A lot of the time, you can just look at a chart and I can almost guess where the moving average is going to be placed. And I can imagine most seasoned traders will be able to do the same as well. I don't think they're overly important. I think they give people more clarity and looking for overall direction. Maybe it's that soothing line that gets people off. But yeah, I wouldn't base your trading strategy. Once again, add it to your toolbox and incorporate it, but I wouldn't base your trading strategy on it. Yeah, that would I would recommend probably avoiding that one. That's it. Jacob, thank you for your question. That was it was good, a little in depth in there. I had a few questions that I wasn't expecting, but I really do appreciate every single one of you that did send an email. The email address is on your screen right now. You can see it at ee@tradedelicious.com. If you want to send a question in here where one of us at the team of TradeDelicious, whoever it may be, can answer them for you, feel free. It's completely free. You get unlimited access to us, and you may even feature in the next video of email exchanges. Guys, I want to say a massive thank you for watching. I hope you enjoyed, and I hope I managed to deliver some clarity to some of those traders who are struggling, and hopefully some of the people that don't have the voice to speak up also pulled some information from this. If you did enjoy, stick around. We love having you around. Make sure you subscribe, hit the like button, and we'll see you soon.